Looking back at all of the finance videos that I posted so far, I realized that I never recorded a beginner's guide or introduction to investing. And I feel like I can't call my channel even partially finance without one. So today I compiled a list of what I think are the basics of investing and some of the tips that I have if you ever wanted to get started. I'm going to be going over what investing is, some of the tips I have on investing, what types of investments are out there, and finally some of my overall tips on specifically stock investing. This video is going to be pretty dense packed with information, so let's jump into it. So first and foremost, what is investing? When you invest into something financially, you're either giving your money to a company, a group, or organization in hopes that your money is going to grow in value. So the reason you invest in a company is in hopes that the company is going to make money or grow in value so that you can make more than the original amount that you invested in. And the reason people might want to grow their money is because they might want to pay for their children's education, they might want to save to buy a house, or they might just be simply saving for retirement. And so the difference between investing and saving is that when you save money, your plan is to use that money for a shorter term compared to if you were to invest that money and use that money many years down the road. When you put your money in a savings account, it's guaranteed to grow a set amount in a guaranteed set amount of time. But that's not the case with investing. Investing can be very volatile depending on which company you invest in. Yes, there's a possibility that you can exponentially grow your money, but there's also a possibility that you may lose all your money as well. But saying all of that, I think doing either of these is better than keeping all of your savings under your bed. Because when you do that, your money definitely isn't growing in value. In fact, over time, it's actually losing value because the economy will always go through some kind of inflation. So what can you actually invest in? There's a pretty wide range of what people decide to put their money into. To name a few of the more popular ones, there's stocks, there's bonds, there's real estate, mutual funds, and many, many more. And now that you know what investing is, I want to go through a few things that you need to consider before you actually start to invest. And I think there's two main things that you need to consider. The first one is that you should probably stay away from investing if you have any remaining high interest debt. And the most common one that people probably think of is credit card debt. And this is because unfortunately, you're not going to find any type of investment out there that's going to outperform how much your credit card charges you for not paying off the full amount every month. So there wouldn't be any point in investing because the money you make from investing is going to go back straight into trying to paying off your credit card debt. And what's even worse is that the money you actually make from investments is not going to even be enough to even out what you have remaining on your credit card debt. So pay off all of your high interest debt before you start investing. The second tip is important, but I would say not as important than the previous one. And that is you might want to have an emergency fund saved up before you start investing. And I think it's pretty obvious to why you should have an emergency fund. Just in case something unthinkable happens, you have money on the side to make it somewhat more bearable. But yeah, I'll just leave it at that. I think it's a lot wiser to save money for a rainy day and have that set just in case before you start investing where the funds might be more volatile. Now I want to go into the meat of this video, some BIT or beginner investing tips. And the first one is to avoid lifestyle inflation. And I'm just going to say this up front, this is hard. It's very tempting for you to want to buy more and better things once you start increasing your income. Your phone that's been working fine for you for years suddenly feels like it needs an upgrade. Or you can now afford to eat out several times a week just because of the bonus that your boss just gave you. But the goal should be to avoid this and live the same way that you always have, regardless of how much extra money you've just made. The wise thing to do would be to put that extra money into investments so you can make that money grow even more. And the second tip I have is that you can start investing with any amount of extra money. If you have extra money on the side that you probably won't be needing for a while, no matter how much it is, you can start investing. Like I mentioned before, if it's sitting in your drawer or sitting under your bed, you're definitely not making money. Instead, you're losing money. But if you're in a place financially where you can't seem to save that much money at the end of each month and you still want to invest, consider using a spare change app that invests for you. I think the most popular app out there right now is called Acorns, and they take the spare change of the transactions that you make every day and invest that extra amount of money. So for example, if you got a cup of coffee from Starbucks for $4.50, the app would round that purchase up to $5 and take those extra 50 cents and put it towards a safe investment. And at first that might not seem like a lot, but when you add up all of these purchases that you do every day, it adds up pretty quickly. Or what would be even smarter is that you could skip out on Starbucks altogether and invest those $4.50 into a stock that you believe in. Another alternative is that you could set up small monthly transfers from your banking account into an investing platform so that it would be automated on the background. And again, like I mentioned before, you should invest the extra money that you make from your 9-to-5 job or from a side hustle and put it on the side to grow it even more. The third tip I have for you is to know what you're investing for and understand the risk. People invest their money for different reasons, and it's usually categorized into long-term and, well, longer term. Parents might want to invest because they want to save up for their children's education in the future. And an example for the longer term would probably be one of the most common reasons as to why people invest, and that is to save for retirement. And the difference between these two types of investments is that you usually want to be more conservative for the investments that you might need to use in the shorter term, because since you might need that money in the near future, there's probably a higher possibility that you don't want to lose that money. But on the other hand, for longer term investments, you might be able to afford to invest into those riskier companies. The reason being that you specifically set aside that money because you know that you're not going to need that in the near future. So for example, these startups always have a possibility for exponential growth. Like, Tesla. But before they get to that exponential growth curve, they need quite a few years to figure out what they're doing. They're going to go through a lot of ups and downs before they find their rhythm. So if you can afford to put money on the side for years on end and ride that wave with them, there's definitely a possibility that if you choose the right company, that it can be very beneficial on your end, to say the least. But also, no matter what investments you're planning to buy, it'll probably be a good idea to understand and familiarize yourself with what you're getting into. And I think there's really two sides you can be standing on. On one side, if you're planning to use the money that you invest in to pay for your living expenses in the near future, like maybe buy a house, buy a car, your risk tolerance probably isn't that high because you don't want to lose all your money towards a risky investment. But on the other hand, for people who can afford to have play money, where they could really just set that money that they put to the side on fire and not really worry about it, they could absolutely put that money towards a risky investment, because if that company exponentially grows and shoots to the moon, then great. But if not, So I would say that if you're saving money for an emergency fund, it would probably be the wisest to put that in a savings account, because there's slow but steady growth over the long term, and you can pull that money out whenever you need it. And investing is more suited for if you don't need that money in the short term, like I mentioned before, if you're saving for a big purchase down the line or for retirement. The next tip I have is to diversify. I'm pretty sure you've heard the saying, never put your eggs in one basket. And well, surprise, it applies to investing too. It's pretty obvious why you would want to diversify. So if one of your investments loses significant value, like, knock on wood, if your house burns down or you go through another recession, you have other investments lying around, so you aren't left with nothing. And a statement you'll hear a lot in the investing world is to buy the dip. This means that when the stock market falls, or when the numbers on your stock portfolio turn red, it means that it's time to buy more. Think of the numbers turning red as a red sale tag that you see when you're shopping at the shopping mall. Your goal is to always buy things on sale or at a discount. So if you have some extra cash lying around, you should buy more of that stock. On the other hand, when the numbers are green, it means that the stock is at retail price. So you could buy that stock at retail, but it would be a lot more better if it was on sale. And this relates to the common mistake that many beginner investors make, because they don't feel comfortable seeing their hard-earned money trend downwards. They'll see it follow that pattern for a couple days, decide that they've had enough of investing because they lost all their money, and pull their money out of the market because they think that it's just going to keep going down in that trajectory. And usually what they realize is that once the market starts going back up, they usually miss the price that they originally bought the stock for. So now if they want to enter the market again, they're going to pay more for that stock that they originally pulled out of. And so what you need to know about this is that in the history of the stock market, yes, there's always been ups and downs along the way, but if you pull back and look at the overall picture, over the long term, the stock market has always trended upwards. And so if you thoroughly research what you put your money in, or you put it into historically stable companies, yes, in the short term, you might lose a few bucks. But over the long term, I can almost guarantee you that you're going to make more money than what you originally invested in. And so if you're one of those people who can't stand seeing their hard-earned money fluctuate up and down, there's all the more reason that you should take my advice and diversify. So if one of your investments, again, knock on wood, goes down the drain, you have other investments that are still keeping you afloat. And my final tip is to play the long game. I know I mentioned this quite a bit already, but I want to go over the idea of compound interest when it comes to investing. So the idea of compound interest is that the interest that you earn on your original investments is added on to that original value, and then that value also earns interest, which is again added on to your original value, and the pattern just keeps going on and on. An easy way to describe it is to think of your investment as a snowball rolling down the hill. As it rolls down the hill, yes, it's going to be slow at first, but exponentially as it gathers more snow, it's going to get bigger and bigger. So the reason this is so powerful is because when you start early, you give your money the time to gather more and more interest over time, taking advantage of this idea of compound interest. So think of it as when you start investing early, you start your snowball at the top of the mountain. Because you're starting at the top, there's a longer distance on the way down, so there's more of a chance that it's going to gather more snow and get a lot bigger. Compared to if you started to invest in the shorter term, it would be like starting off your snowball in the middle of the mountain. Yes, your snowball can still grow, but because there's a shorter distance to the bottom of the mountain compared to if you started at the very top, your snowball is probably not going to get that big. So the bottom line is to start early and don't withdraw the interest that you earn from your investments. Put those interests back in so that they can keep growing exponentially over time. Now that we've gone through a few tips, I want to go through a few type of investments that you can get into. And like I mentioned before, there's a lot of different types of investments. And if I were to go through each type of investment in depth, each of them could be their own separate video. So I might make those later down the line. Let me know if you would like to see it down in the comments below. But when it comes to investing, I think 3 of the most popular categories that people put their money into is bonds, stocks, and real estate. And out of these 3, I feel like the most popular one and the one that's most accessible to most people is stocks. So I'm going to go more in depth on that specific one later on. But let's get into the different types of investments. So the first one is bonds. And when I was trying to figure out what exactly a bond was, I got kind of confused. I looked up the definition and I got this. A bond is a fixed income instrument that represents a loan made by the investor to a borrower. And if you understand that, I'll admit you're probably a lot smarter than me, but I had to look more into it to find a more simplified definition. And what I found is that you can think of a bond as a tool that the government uses when they want to raise money. So what they'll do is that they'll sell you these bond agreements, and in return for borrowing your money, they'll agree to pay you back on a specific date while sending you a few interest payments along the way, usually around twice a year. And there's a lot of different types of bonds, but they all follow the same idea. And you can usually purchase these directly from a government or from a brokerage or trading platform. And the second and probably the most popular type of investment is stocks. And in case you don't know what a stock is, it's essentially the value of a tiny piece of a company. So depending on how many stocks you buy, you own a little bit of a company when you buy a stock. And again, depending on which stock you buy, you could either make a lot of money or lose a lot of money, depending on if that particular company is extremely successful or goes bankrupt. And nowadays, investing in stocks has become really accessible. There's a variety of free trading platforms out there, the most popular one probably being Robinhood. But there's also platforms like Webull, M1 Finance, Fidelity. And yes, if you go into the nitty-gritty, it can get pretty complicated, but the overall definition of stocks is pretty easy to understand. And I'll go through some of the basics of investing in stocks after I go through this last type of investment. And this last one is pretty obvious in a lot of people's goals in life, and that is real estate. This type of investment can provide the most return in the shortest amount of time, but it also has the highest barrier of entry. Real estate encompasses a lot of things and involves buying houses, apartments, or really any kind of building whatsoever. Anything that you can rent, buy, fix it up, and flip can be counted as real estate. But the process of doing so can get pretty complicated pretty quickly, which is why you usually need to get a license to do so. But you usually can buy real estate from the property owner or from the real estate agent that's working with the property owner. And I don't think this needs that much of an explanation. Everybody pretty much knows the general idea of what real estate is and how it works. But again, if you would like to know more about it, comment down below and I'll make another video on real estate very soon. So now that we've gone through the main type of investments, I want to go through a few tips I have about stock investing because I feel like it's the most accessible and probably the one that people would be most interested in learning more about. So the main purpose of investing in stocks is obviously to grow your money as fast as possible. If the stocks that you invested grew as fast as the money that you put in your savings account, there'd really be no point. So my first tip, if you are looking into invest in stocks, is to research the company that you're putting your money into. If you're looking for a safe investment with stable growth, maybe put your money into a more established company where you know they won't announce bankruptcy out of nowhere. And if you're having trouble choosing a company, I would suggest that you invest into a company that you already use daily. So if you're a student and you have an Apple computer and you use that every day, if you like it and you're satisfied with how it works, invest into Apple. Or if all of the shoes you have in your shoe closet are all Nikes, it's pretty obvious that you like their shoes and are satisfied with how they feel on your feet. So you could buy some Nike stock as well. Now, on the other hand, if you're looking for a company with possibility for exponential growth, all the more reason that you should thoroughly research that company before you put your money into it. Because many of these startups are the type of companies where you hear about them for a period of time, and then a couple months later, it'll seem like they disappeared off the face of the earth. So before you invest, decide what your goal is. Are you looking for stable growth, or are you looking to exponentially grow your money? That way you already have your expectations set, so you roughly know how your money is going to perform. And also be wary of picking individual stocks, since everyone, for the most part, has the same access to all the research online. Depending on which stock you're looking to buy, if you're hoping that the stock price is going to go up on that specific company, there's usually someone on the other side hoping that that same stock from the same company is going to go down. Which brings me to my second tip, and that is, like I mentioned many times in this video, diversification. Like with all the different asset classes that I mentioned before, real estate, bonds, stocks, you should also diversify the different type of stocks that you own should you choose to invest. If you're a big fan of tech, yes, it'll probably be a good idea to invest in some of those big tech companies that you believe in. But you probably also have a few different restaurants that you frequently go to. If they have stocks, maybe you'd want to buy those as well. What about your favorite clothing brands that you always frequently shop at? You see my point? Investing in these different sectors of stocks, make sure that if one of these sectors has a bad day, you have other stock investments that you can lean back on. Like what happened when the pandemic hit and the travel industry plummeted, along with the other recovery stocks. If you had only invested money into those companies, you would have had a significant loss. And one of the safest, most stable ways to invest, it's what I'd like to call the lazy way to invest. If I could have you just remember one thing that I mentioned in this video, you could take this tip and be set for the rest of your investing career. And it comes down to 3 letters. ETF, or Exchange Traded Fund. An ETF is a group of stocks that's combined into one fund. So when you buy an ETF fund, you're buying bits of all of these different companies that are part of this group. So you own a little bit of the stock of all of these companies. Owning an ETF allows you to diversify. And what's even better is that there's ETFs for a lot of different stock sectors and a lot of different asset classes. So you could buy a blue chip ETF, a growth ETF, or if you wanted to branch out into different asset classes, there's a real estate ETF. So you could invest into real estate without buying a house. And the best part is that historically, ETFs over a long period of time have always increased in value. So hold it for long enough and you'll always make more money than what you originally put in. I like to think of an ETF as a better savings account. If it's for money that you won't need in the short term, put that money into an ETF, forget about it, come back in a couple of years and see that money grow relatively significantly for just putting it there. There's really no downside that I found to investing in ETFs other than being a bit expensive to get into depending on where you are financially. And I would say that if you don't have enough money on the side to buy a few shares of an ETF, then you probably aren't at a place financially to where you can get a significant return if you wanted to invest. I'm not saying that you shouldn't, but don't expect to double or triple your money investing into an ETF. It's pretty stable, linear growth over a long period of time. But that's it. That was what I think are the basics of investing. A few of the basic tips that you should know if you ever wanted to invest. If you actually made it all the way to the end, I really appreciate it. Hopefully you learned something new from this video. And if you wouldn't mind hitting the like button so I know how many people actually made it to the end. But like always, if you made it to the end, you clearly didn't find me too boring. So go ahead and click the subscribe button down there. So that's been it for this one. Thank you so much for watching, and I'll see you very soon in the next video.